The institution that literally supervises the world's central banks just warned that the AI investment boom could crash equity markets and threaten the global economy. Not a hedge fund short seller looking for press. Not a perma-bear newsletter. The Bank for International Settlements, the BIS. The place central bank governors actually answer to. When that institution uses language like slump and jeopardize, the word choice is deliberate, and the implications are precise. So the question you need to sit with for the next 12 minutes is this. Are we watching the early innings of the greatest technology deployment in history, or are we watching capital misallocation on a scale that ends badly? Let us be precise about what the Bank for International Settlements is, because that context is everything. The BIS is headquartered in Basel, Switzerland. It is sometimes called the central bank of central banks. It does not set monetary policy directly, but it coordinates, researches, and advises the institutions that do: the Federal Reserve, the ECB, the Bank of Japan. When the BIS publishes a warning, it is not opinion journalism. It is the product of economists who have access to data and cross-border capital flow information that no private analyst can replicate. The warning, as reported, centers on the AI frenzy, their framing, not ours, and its capacity to trigger a stock market slump and jeopardize the economy. Two things are worth unpacking there. First, the word frenzy implies a valuation disconnect from fundamentals. Capital moving faster than the underlying economics can justify. Second, jeopardize the economy is a macro-level concern, not just a market concern. That is the BIS saying, this is not a sector problem. This is a systemic risk conversation. Historically, the BIS has flagged systemic risks before they fully materialized. Their warnings about housing market imbalances in the mid-2000s were documented and largely ignored. Their warnings about leverage and low volatility complacency in 2017 and 2018 preceded volatility spikes. The track record is not perfect, but the methodology is serious. The actionable insight here is straightforward. When the BIS uses this language, institutional risk managers read it. That means the warning itself, regardless of whether it proves correct, influences the behavior of the largest capital allocators on Earth. Perception, at sufficient scale, becomes reality. Smart money is now pricing in at least a non-trivial probability that AI-heavy indexes face a correction. That changes hedging math, and it changes portfolio construction math, even if you are long-term bullish on the technology itself. The BIS warning does not exist in isolation. This week's headlines reveal 3 specific structural fault lines that make the warning more than theoretical, and each one deserves focused attention. Fault line 1, macro backdrop deterioration. A jobs report is dropping this week and oil prices are falling. Those 2 data points together create a nuanced signal. Falling oil is often read as disinflationary, which sounds friendly to equities. But falling oil in an environment where AI infrastructure spending is surging and energy demand should theoretically be rising tells a different story. It suggests demand destruction signals elsewhere in the economy are winning. A jobs report that comes in soft would confirm that the consumer-facing economy is weakening precisely as corporate capital expenditure on AI is accelerating. That divergence is not inherently sustainable. Fault line 2, climate and infrastructure collision. The AI boom is colliding with severe weather in ways that are only beginning to be priced into real assets. AI infrastructure, meaning data centers, the physical compute layer that all of this runs on, is extraordinarily energy-intensive and geographically concentrated. Severe weather events disrupt power grids. They disrupt cooling systems. They create exactly the kind of force majeure risk that does not appear in a discounted cash flow model, but absolutely appears in quarterly earnings calls when capacity goes offline unexpectedly. This is not a hypothetical. Data center operators and hyperscalers are beginning to treat climate exposure as a first-order infrastructure risk, and the insurance market is pricing it accordingly. Fault line 3, semiconductor concentration. South Korea's government confirmed this week that Samsung and SK Hynix are committing to AI and semiconductor megaprojects. That is a bullish signal for supply growth, but it carries a hidden risk. The advanced memory and chip supply chains critical to AI buildout are heavily concentrated in a small number of facilities in a small number of countries. South Korea is geographically proximate to one of the world's most significant geopolitical flashpoints. Concentration plus geopolitical exposure plus the scale of capital commitment required for these megaprojects creates a supply chain fragility that the market's AI valuations do not appear to fully reflect. The actionable read: the AI trade is not one risk. It is a stack of risks with different timelines and different triggers. Treating it as a single thesis is how investors get caught. Here is where most financial content fails you. It either says the bubble is about to pop and you should run, or it says ignore the critics and hold everything forever. Neither is intellectually honest. This is not financial advice, but it is a framework grounded in how institutional risk desks actually think. The first principle is distinguishing between the technology thesis and the valuation thesis. The BIS is not saying artificial intelligence is not transformative. No credible institution is making that argument. What the BIS is saying is that the capital flowing into AI-adjacent equities may be pricing in outcomes that are too optimistic, too front-loaded, or insufficiently discounted for the real risks embedded in the build-out. A technology can be genuinely revolutionary and simultaneously be the vehicle for a speculative overshoot. Those two things have coexisted many times in market history. Railroads in the 19th century, internet infrastructure in the late 1990s. The underlying technology won. Many of the valuations attached to it during the boom did not. The second principle is what concentration risk actually costs you. When a significant portion of major indexes is concentrated in a cluster of AI-adjacent names, a derating of those names does not stay confined to a sector. It becomes an index event. Investors who believe they are diversified because they hold broad index funds may be carrying more concentrated AI exposure than they have mapped. Understanding what percentage of your portfolio's performance is attributable to the AI premium embedded in large cap tech is not a bearish exercise. It is basic portfolio hygiene. The third principle, and this is the one most relevant to the current moment, is that warning signals from credible institutions change the probability distribution. They do not determine the outcome. The BIS could be early. The BIS could be wrong. But when the most credentialed financial institution on the planet publicly flags a risk of this magnitude, the asymmetry of ignoring it versus taking it seriously is no longer balanced. The cost of being aware is zero. The cost of being blindsided in a concentrated, highly leveraged market structure is not. We opened with a question: greatest technology deployment in history or capital misallocation at scale? The honest answer is that it can be both, and in markets, timing is everything. The BIS did not say AI fails. They said the frenzy around it creates systemic risk. That is a precise and important distinction. The follow-up question, the one this video does not answer, is what a controlled unwind actually looks like versus an uncontrolled one. That is the next video. Subscribe so you do not miss it.